Losing your property, whether it's from a natural disaster or, a theft, it's just devastating. And while nothing can really bring back what you've lost, there might be a little bit of financial help hidden in the tax code that you don't even know about.
That's right, the IRS sometimes lets you deduct those losses on your tax return. But, and this is a big but, figuring out if you qualify and for how much can honestly feel like trying to solve a puzzle in the dark. So today, we're going to turn on the lights. We're going to break it all down, what counts, how you do the math, and what you need to do to get through it.
So here's our game plan for today. We'll start with the basics, but then we're going to jump straight into this huge new rule that has changed everything for pretty much everyone. After that, we'll get into the nitty-gritty. What does the IRS actually mean by a casualty? Then comes the math. We'll walk right through it. We'll even look at a really weird twist where a loss can actually become a gain. And then we'll wrap it all up with your next steps.
Okay, let's just get right to it. If you're hoping to deduct a loss on your personal property, you have to know about this major rule that's in effect from 2018 all the way through 2025. This is, without a doubt, the first and biggest hurdle you have to clear.
So here it is, the bottom line. For these tax years, all those things on the left, a common house fire, a car accident, even having your stuff stolen, you can't deduct those personal losses anymore. The only way to potentially get a deduction for personal property loss right now is if it happens as part of an event on the right, a federally declared disaster. That's it. That's the only game in town. So that begs the question, right? What in the world is a federally declared disaster? Well, it's exactly what it sounds like. It's an official declaration from the president that says an event was bad enough to need federal help. The key thing for you is that you can't just assume your flood or storm qualifies. You have to check. The best place to do that is the official FEMA website, fema.gov.
Okay, so let's say you've cleared hurdle number 1. The event that caused your loss was a federally declared disaster. Great, but you're not done yet. The IRS has another requirement. The loss itself has to qualify as a casualty. And trust me, their definition is super specific. Here they are, the 3 magic words: sudden, unexpected, or unusual. Sudden means it happens quickly, not over time. Unexpected means you couldn't have seen it coming. And unusual means, well, it's not something that happens in your normal day-to-day life. Your event has to check all 3 of these boxes. You can probably guess some of the classic examples here: hurricanes, tornadoes, floods, fires. Yeah, those are pretty clearly sudden and unexpected. Vandalism counts too. Even a car accident can qualify, as long as it wasn't your fault because of, willful negligence. So if you decide to start a street race and wreck your car, that's on you. Now, this is where a lot of people get tripped up. Things that happen slowly over time, they don't count. Termite damage, for instance, is gradual. A water heater that finally bursts because it got old and rusty, that's just progressive deterioration. And no, sorry, you can't claim a casualty loss because your puppy decided your antique chair was a chew toy. The IRS just doesn't see that as unusual enough. All right, you've cleared the first 2 big hurdles. It was a federally declared disaster, and it was a qualifying casualty. Now, it's time for the math. And look, I know this is where eyes can start to glaze over, but stick with me. We're going to take this one step at a time. It's more straightforward than you think.
Okay, step 1 is just figuring out your starting number. You need 2 key figures. First is your adjusted basis. The easiest way to think about this is your total investment in the item. So for your home, it's what you paid plus the cost of major improvements. The second figure is the decrease in its fair market value right after the event. Now here's the kicker. You have to use the smaller of those 2 numbers. From that smaller number, you then subtract whatever your insurance paid you. Let's make this real with an example right from an IRS publication. Let's say your lakeside cottage was destroyed. Your adjusted basis, what you had invested, was $144,800. The drop in value was just a bit more at $145,000. So you have to take the smaller number, the $144,800. Then let's say your insurance company sent you a check for $130,000. You subtract that, and you're left with an initial loss of $14,800. But hold on, we are not done yet. Step 2 is where the IRS really narrows things down. They apply 2 limits that shrink your deduction. First, they make you subtract $100 for each event. It's just a flat reduction. After that comes the big one. You have to subtract 10% of your adjusted gross income, or AGI, from your total loss. I want to pause on this number for a second, because this is the real killer for most people. The 10% of AGI rule is specifically designed to make sure that only the most financially devastating losses result in a tax deduction. For a lot of folks, this one calculation just completely wipes out any chance of a deduction. So let's finish our cottage example. We start with that initial loss of $14,800. We subtract the $100 rule, which brings us to $14,700. Now let's say your AGI for the year was $80,000. You have to subtract 10% of that, which is $8,000. And there you have it. Your final actual deductible loss is $6,700. See how quickly that initial loss got whittled down? Now for something that just sounds, well, wrong. It seems impossible, but sometimes a casualty loss can actually result in a taxable gain. Yeah, you heard me right. Let's see how that can possibly happen.
It's a crazy question, but the answer is a definite yes. If the money you get from your insurance company is more than your adjusted basis in the property, the IRS looks at that extra money as a gain, and you might owe taxes on it.
The formula is really simple. If the insurance check is bigger than your adjusted basis, you've got a potential taxable gain. This happens a lot with property that you've owned for a really long time. You know, your basis might be the super low price you paid for the house 30 years ago, but your insurance policy covers the very high cost of replacing it today. That big gap between the two, that's your gain.
But okay, don't panic. There's a way out of this. The IRS lets you postpone reporting that gain if you use the money to buy a similar replacement property. You generally have about 2 years to do this, and if it was your main home in a federally declared disaster area, they often give you up to 4 years.
Whew, okay, we've covered a ton of ground here, from that huge new disaster rule all the way down to the nitty-gritty math. So let's bring this all home. Let's boil it all down into a clear, simple checklist you can use to figure out your next steps.
Here's your 5-step action plan. 1. First thing, go to FEMA.gov and confirm the event's official status. 2. Document everything. I cannot say this enough. Photos, receipts, appraisals, you need proof. 3. Run the numbers yourself. Use the steps we just went over to see if you even have a deductible loss after all the limits. 4. If you do, you're going to use IRS Form 4684. And 5, and I really mean this, seriously think about getting professional help. This stuff is tricky, and a good tax pro is worth their weight in gold here.
When it's all said and done, trying to claim a property loss is really about the story that your paperwork tells. It really shines a light on just how valuable good record keeping is, not just for taxes, but for proving what you had when the absolute unexpected happens. So the real question to ask yourself is this: are your records ready?